with the definitions part. So IAS 16 on property, plant, and equipment is primarily applicable for tangible assets. So the definition of property, plant, and equipment, the definition as per the IAS 16 is they are tangible assets which are held for is tangible assets or there's another accounting standard now for intangible assets. So we don't use intangible assets under this property, plant, and equipment. Prior to this, tangible assets and intangible assets were covered under the same um, accounting treatment, but now they are different. So there is one accounting standard for tangible assets and another accounting standard for intangible assets. So the property, plant, and equipment under IAS 16 is tangible assets which are held for use in the production or provision of services. So this could be your warehouse, this could be your office building, store, manufacturing facilities, machineries, furniture and fixture in the machine in the factory. But primarily these assets are held for either production or provision of services. So it could be your laptop as well, which you are going to use for presentation. Like I am using the laptop for my presentation for providing the services. So for me, this laptop becomes my property, plant, and equipment for my business. So these are tangible assets which are used for provision of production and provision of services. Or it could be rental to others. So there are certain businesses which hold the property, plant, and equipment as an asset and give it out to other businesses as on a rental basis to use in their business and services. So it's not that only your business services, but your business is maybe to provide the services to other companies. So it means it could be car, it could be buildings, it could be furniture, it could be plant, it could be machines, it could be anything. So these are the let's say car rental, right? So it could be tangible assets which we held for renting out to others and for administration processes. So every business, mostly businesses need furniture, fixture, table, chairs for sitting, laptops for working, computers, electrical equipments for their office purposes, coffee machines in their offices, water heaters in their offices, air cons in their offices, fire extinguishers, firefighting equipments for the building code requirements and the office building itself. And sometimes we don't own the office, sometimes we rent, let's say, a floor in the office, and we are renovating that to add our furniture, add our interiors, furnishing, repainting, lighting, and all those kind of things. So even though we don't own the building itself, we don't own the place itself, we own the interiors for a certain period of time. So if let's say your contract is within 1 year, it means that you own these assets only for a year. So in that case, you will these are assets for you only for that particular year. But if your contract is, let's say, for 10 years, then it means you own these assets for 10 years if they go up to 10 years, or towards or throughout the life of the asset if that is shorter than 10 years. So it's not only that you own the building or you own the place, but if you have done any improvements and you have a right to use that improvement for a considerable period of time, that becomes a tangible asset for the business. So the definition is not limited to something we own on paper, but something to which we have a right also. So now IAS 16 includes right of use assets as well. And the key here is that it's expected to be used for more than one accounting period. That's a very critical thing. What is accounting period? Usually, the accounting period is 1 year because you are drawing up your balance sheet only after a year end, financial year end, calendar year end, whatever you follow. That accounting period is going to be determining that what if the assets is going to be used within that particular 1 year, then it's not a fixed asset technically from the IAS 16. But if it's more than 1 year, then it's going to be a fixed asset. Now, there are usually considerations that whether every asset which is more than a year is going to be a fixed asset. Let's say you are using small phones, Nokia phones. They can be for more than 1 year, but they are very insignificant value. Should we put them as a fixed asset? We are buying a calculator just a normal calculator for office. That calculator is expected to you be used for 2 years, 3 years, 4 years. My calculator is working for me for 5 years. So should we put that in fixed assets? There are pen stands, there are telephones, small ones, there are small desk chairs which have not much of value, but they can be used for a considerable period of time, at least more than an accounting period. Should we put them in fixed assets? If let's say we are running a very large business, millions of dollars of revenue or factory, and we are buying some sockets, so that becomes a part of the building, but so that is expected to be used for more than a year. Should we put them in fixed assets? So these are normal questions that we get to ask for from accountants. So what should be the answer? Well, the answer will depend on, technically, yes, if the life of the asset or anything which we are buying and spending is more than a accounting period, it has to be property, plant, and equipments. Now, the reason why we do this is because we want to match the cost of doing the business with the revenue. So if something is going to be used for let's say 2 years, if we charge that to profit and loss statement and don't recognize as a property, plant, and equipment, that will go to the balance sheet. That will go to our profit and loss immediately in that particular month itself, and the profitability will go down for that year. And the next year, since we are still using the asset, we are taking the advantage of this asset to be used in our business, but there is no charge for it, right? Because there is no account. The depreciate the expense has already been charged last year, so we are not charging anything this year. So the profit of this year is overstated. This is the major concept why we need to do the why we need to recognize the property, plant, and equipments or to an expense. So that's the key criteria. But if they are like small assets, then they are tend to be inexpensive. So then the question will come is whether it's significant for the profitability of the business or not. Let's say you are buying an asset which is costing you $100, but the total turnover of the business is let's say $1 billion. So when you are putting that $100 asset into the expenses, it does not come into even the rounding of decimals. So you can easily write them off as an expense, depending on how often you buy these kind of assets and what are the quantity in total spent over these, right, over the entire year, if it's significant or not. If it's significant for the profit, then yes, you have to recognize them as a fixed asset, because you don't want to hit the profit and loss statement in 1 year, rather than that you want to put into 2 3 years, whatever is the useful life of the asset. And we are going to look at the useful life of the asset expected to be used. What is the useful life of the asset, rather than how much you think I can use on a fixed on in actual terms. So instead of looking at what is the actual usage, we are going to use what is the expected use or is the useful life. So let's say a calculator. If we know that this asset is going to be, we know we can use it for more than 1 year, more than 2 years if it's all good. But let's say the engineering based on the heavy usage of the calculator, we think that after 6 months or after a year, it will start giving the errors and we may need to change. So then the useful life of this particular item is 1 year. So we are going to say that this will be charged to the profit and loss statement. Uh, if let's say the profit and loss statement, that the profit of the business is, or that is used for materiality is very small, any spend should be recognized as a should be recognized as a property, plant, and equipment if it's for more than a year. And if the business is quite large, then you can have a policy whether you want to put into fixed property, plant, and equipments or charge to expenses. That depends on the management policy. What does the management or the person who prepares the financial statement feels about the possibility of the business? If the preparer or the management feels that charging small expenses to a certain level is better to put into the profit and loss statement, then we need to follow that. right? And that need to be disclosed in the notes and accounts. So that's a disclosure requirement which we have to put in our notes to account, that what is our capitalization policy. This is normally called capitalization policy, and what kind of assets we are putting into property, plant, and equipment, what assets we are putting into the expenses. So, for example, in hotels, there are small, very small, like spoons, silver spoons, chinaware, glassware, which is expected to be used in quite number of years. But many hotels, because they know that it's not a very significant amount, and considering the total profitability of the hotel or the overall profit of the hotel, the amount does not significantly affect the business, affect the profitability of the property. So that the true and fair picture of the profitability of the operations of the hotel is not going to be impacted if we charge that to expenses to a certain level. So normally there are specifically designed capex policies depending on the size of the hotel. Let's say up to $100. If we buy anything, it will not be charged to the property, plant, and equipment. It will charge to the expense. The another important aspect of deciding this, whether to classify this particular spend as a property, plant, and equipment or not, also is the your ability to maintain the register. Because once you have a fixed asset, property, plant, and equipment, and you put into the balance sheet, every time the auditors are going to ask if you have some listing of all your property, plant, and equipment, so that they can physically match, because that is going to appear in the balance sheet as a value. So for auditors to certify that this value exists in the balance sheet, they have to physically verify it. For to do a physical verification of all the property, plant, and equipment, they need a listing. So the more smaller items you put into the property, plant, and equipment, the more cumbersome it will become for somebody who is checking to go and verify all the assets. And all the time you will have shortages, and all the time you have to do an accounting adjustment to charge off or to write off the hassle to the property, plant, and equipment. So the hassles of uh, capitalizing small items is quite big. So normally the big companies, the management decide up to a certain level, expenses will be charged to the profit and loss statement, so that it's done, right? It's finished. But there are other considerations. If you start charging everything, if you put everything into property, plant, and equipment, uh, your tax will be more. So we will discuss that concept later on in our slides. So but there are certain assets which are expressly excluded from the property, plant, and equipments from the scope of this. So there are non-current assets held for sale. So basically, these assets are sorry, the number is wrong. It's IND, but there are IAS references to these numbers. So there are non-current assets held for sale, which usually include the investment properties. Let's say you have invest into the property for creating a rental income or for selling it and getting a capital gain, not for the purpose of use of the business or not for the administrative purposes. So they are called non-current assets held for sale. So these are not treated as property, plant, and equipment. There is a separate accounting standard for that, and that requires different treatment, different disclosures. Then there are investment properties. Oh, sorry, I just talked about investment properties. Non-current assets held for sale means those assets are ready for sale. So you might have used them in the business in the past, but now they are not being used for the business, but you just hold them for sale so that you can get a better value. So those assets are also excluded from this. Mineral rights, mineral ores are also excluded. Agriculture assets are excluded. Intangible assets are excluded. So these standards are they are different standards for these type of assets which are dealt with